Hello, in this video we will learn about international financial management. So let's start. In this session we shall cover what is a MNC, financial management of an MNC, foreign exchange management and sources of raising finance. So what is a MNC? A MNC may be defined as an organization which has investment and sales in two or more countries. Most experts are of the view that an organization having at least 50% of its business outside its home country and which derives 50% of its total profits from international operations is a MNC. Financial management of MNC. The problems of financial management of MNC are slightly more complex than those of a domestic organization. Foreign exchange fluctuations, financing facilities, government tax and investment policies, and political risk, etc. Reason for investing abroad. The decision to invest capital in a project abroad is based on considerations of expected risk and return. What shall specifically encourage a corporate to invest abroad would include reduction in risk, higher return, tax benefits, and seeking politically stability. Foreign exchange management, exchange risk. The price payable to a foreign buyer can be in the seller's or buyer's currency or an international currency. The buyer will have to purchase the necessary foreign exchange in order to make the payments. A currency would not be preferred if it is depreciating rapidly in value. The government prefers to have another currency, or the other currency is not that acceptable. An exchange rate represents the number of currency units of one currency that can be exchanged for another country's currency funds. The currencies of major countries are traded in an open market, and rates are determined by the prevailing demand and supply forces. Foreign exchange management, currency exposures. First one is accountancy exposure. So if the exchange rates between the two countries change in the reporting period from that in the previous period, there may be a foreign exchange gains or losses. Transaction exposure. In case there is a commitment to receive or pay a specified amount in foreign currency, an appreciation or depreciation in exchange rate can be result in a loss or a gain. Economic exposure. These relate to the effect of exchange rate changes on the international competitiveness of a company. Ways to manage exchange rate risk. First one is forward market, second one is foreign currency swap. So in this market, one locks in the exchange rate by entering into contract to buy specified currency at a specific time at a specified rate. Foreign exchange contracts are made through the international departments or of large commercial bank. Foreign currency swap. This is an agreement between the two parties of exchange one currency or for another at a specified future date and at a specified exchange ratio. It is a simultaneous spot and forward transition, with the forward transition reversing the original spot transaction. Ways to manage exchange rate risk. Arbitrage. It is a situation whereby a guaranteed profit can be made by purchasing and selling a currency simultaneously in one or more foreign markets. Another way is long-term rollover cover or exposure netting and managing investment in higher economy. So these are the ways of foreign exchange management. Thanks.